In this video, we're going to talk about how to invest like Warren Buffett for beginners. So before starting, please like this video and subscribe to the channel for future updates. Who hasn't heard of Warren Buffett, one of the world's wealthiest individuals who routinely ranks high on Forbes' billionaire list? As of April 19, 2022, his net worth was estimated to be $125 billion. Buffett is a philanthropist and a businessman, but he's best renowned for being one of the most successful investors in the world. As a result, it's no surprise that Warren Buffett's investment strategy has become legendary. Buffett adheres to a number of key principles and an investment philosophy that is widely adopted around the world. So what exactly are the keys to his success? Watch till the end to learn more about Buffett's method and how he's amassed such a fortune through his investments. A brief history of Warren Buffett. Warren Buffett was born in Omaha, Nebraska in the year 1930. At a young age, he had an interest in business and investment, including in the stock market. Buffett began his study at the University of Pennsylvania's Wharton School before returning to the University of Nebraska to earn a bachelor's degree in business administration. Buffett went on to Columbia Business School to pursue his master's degree in economics. Buffett began his work as an investment salesman in the early 1950s, but Buffett Associates was founded in 1956. He took leadership of Berkshire Hathaway less than 10 years later in 1965. Buffett revealed his intention to donate his whole fortune to charity in June 2006. The Giving Pledge campaign was founded by Buffett and Bill Gates in 2010 to inspire other affluent individuals to explore philanthropy. The philosophy of Warren Buffett. Buffett invests in the Benjamin Graham Value Investing School. Value investors seek securities with unjustifiably low prices compared to their intrinsic value. Although there is no commonly acknowledged method for calculating intrinsic value, it is sometimes approximated by examining a company's fundamentals. The value investor, like bargain hunters, looks for companies that are discounted by the market or that are desirable but are unknown to the majority of other buyers. Buffett takes the concept of value investing to a new level. The efficient market hypothesis is contested by many value investors, EMH. According to his hypothesis, stocks always trade at their fair value, making it more difficult for investors to buy undervalued equities or sell them at inflated prices. They believe that the market will eventually begin to favor those high-quality stocks that have been undervalued for some time. Warren Buffett has always emphasized the necessity of investing in oneself as a strategy of achieving success. This involves making wise financial decisions and expanding your expertise in the areas you want to participate in. Buffett, on the other hand, is unconcerned about the stock market's supply and demand dynamics. In actuality, he isn't very interested in the stock market's activity. This is the implication of the famous translation of Benjamin Graham's quote, "The market is a voting mechanism in the short run, but a weighing machine in the long run." He considers each company as a whole, so he selects companies entirely on the basis of their whole potential. Buffett doesn't seek monetary gain from these equities, but rather ownership in high-quality companies that can provide earnings over time. Buffett isn't concerned with whether the market will eventually recognize a company's worth when he invests in it. He is concerned about the company's ability to generate profits. Buffett's approach. When Warren Buffett assesses the relationship between a stock's level of excellence and its price, he asks himself a series of questions. Keep in mind that these aren't the only items he looks at. Rather, they're a quick rundown of what he looks for in his investment strategy. Number 1, company performance. The stockholder's return on investment, ROI, is another term for return on equity, or ROE. It displays how much money owners make from their stock. Buffett compares a company's ROE to that of other companies in the same industry to see if it has consistently done well. The following formula is used to compute the ROE. Net income x shareholders' equity equals return on equity. It's not enough to look at the ROE from the previous year. To evaluate historical performance, the investor should look at the ROE over the precious 5 to 10 years. Number 2, company debt. Another important factor Buffett examines is the debt-to-equity ratio, DE. Buffett prefers a low level of debt so that earnings growth is derived from the shareholders' equity rather than borrowed funds. This is how the DE ratio is calculated. Total liabilities divided by shareholders' equity equals debt-to-equity ratio. The higher the ratio, the more debt, not equity, is used to fund the company's assets. A high debt-to-equity ratio might result in unpredictable earnings and expensive interest costs. Investors sometimes use solely long-term debt instead of total liabilities in the formula above for a more strict evaluation. Number 3, profit margins. A company's profitability is determined not just by its profit margin, but also by its ability to constantly increase it. Net income is divided by net sales to arrive at this figure. Investors should look back at least 5 years for a decent idea of past profit margins. A high profit margin suggests that the company is doing its job well, but growing margins indicate that management has been exceptionally efficient and successful in keeping costs under control. Number 4, is the company public? Only companies that have been around for at least 10 years are considered by Buffett. As a result, most technological businesses that went public in the last decade would not be on Buffett's radar. He stated that he doesn't understand many of today's technological companies and only invests in businesses that he completely comprehends. Identifying firms that have endured the test of time yet are now undervalued is the key to value investing. In contrast to technical investing, which looks at stock's price and volume as well as how the price has moved historically, value investing concentrates on a company's financials. Never undervalue the importance of past performance. This shows the company's ability, or lack thereof, to increase shareholder value. However, remember that a stock's previous success does not guarantee future results. The value investor's goal is to figure out if the company can perform as well as it did previously. This is inherently difficult to determine. Buffett, on the other hand, appears to be a natural at it. One thing to keep in mind about public firms is that the Securities and Exchange Commission, SEC, mandates them to file financial statements on a regular basis. These documents can assist you in analyzing critical corporate data such as present and historical performance in order to make informed investment decisions. Number 5, commodity reliance. This inquiry may appear to be a bold approach to narrowing down a company at first. Buffett, on the other hand, considers this a crucial matter. He avoids companies whose products are indistinguishable from their competitors and those that rely primarily on a commodity like oil and gas, but not always. Buffett sees little difference between a company and another company in the same industry if it does not provide anything unique. Buffett refers to a company's economic moat or competitive advantage as any feature that is difficult to imitate. A competitor's ability to increase market share is more difficult the broader the moat. Number 6, is it cheap? This is when it gets interesting. Finding companies that fit the other 5 criteria is one thing. Evaluating whether or not they are discounted is the most challenging aspect of value investing, and it's Buffett's most valuable asset. To estimate a company's intrinsic worth, an investor needs to examine a variety of business characteristics such as earnings, revenues, and assets. And a firm's intrinsic value is frequently higher and more complicated than its liquidation value, which is the value of a company if it were split up and sold today. Intangibles such as the value of a brand name, which is not immediately disclosed in the financial accounts, are not included in the liquidation value. Once Buffett has determined the company's intrinsic value, he compares it to its present market capitalization, or entire worth or price. Doesn't it appear to be simple? Buffett's success, on the other hand, is dependent on his unrivaled ability to precisely determine its underlying worth. While we may define some of his criteria, we have no way of knowing how he developed such a perfect understanding of the value calculation. Number 7, approach your investments with a long-term mindset. One of the most important Warren Buffett quotes on investing you can absorb is, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." He doesn't choose stocks just because he thinks their prices are going to rise this week, this month, or even this year. Buffett buys stocks because he wants to own those businesses for the long term. He still sells stocks frequently and for a variety of reasons, but approaches most of his investments with the mindset of owning them forever. And if you can't get into a forever mentality with your stocks, Buffett has called a set-it-and-forget-it investment like an S&P 500 index fund the best investment most people can make. So, what do you think about our video? Let us know in the comment box below. Please do like the video and subscribe to the channel for future updates.